Welcome back to Investing Talk Podcast. Today, we're focusing our attention entirely on Robinhood markets. And we're tackling that really contested question right now. Is Robinhood a good time to buy? Our mission today is pretty straightforward. We're going to break down the company's recent financials, look at the technical setup, dissect the key risks, and pinpoint some upcoming catalysts. And this is all based entirely on the sources provided.
Yeah, the goal is really to synthesize all this so you can kind of answer that question for yourself. But before we jump into the analysis, please take a moment to subscribe, like, and comment. It really helps us out. Also, if there's a specific company you want us to look into for a future show, please drop it in the comments below. We do read them. Okay, let's get into this financial story. So when we talk about Robinhood, I mean, this is a company that really, pioneered the modern retail brokerage. They were innovators targeting younger, mobile-first investors. And they really shook things up with commission-free trading, and this was key, no minimum account requirements.
Right, a very disruptive strategy. Definitely. But the big question now is, does that disruption actually translate into stable, sustainable profit?
And that stability, that's exactly what we need to look at. The 2024 fiscal year financials, they really show a critical turning point. They actually managed to swing into profitability, posted a small net profit, about $120 million.
Okay.
Now, if you compare that to 2023, they had a hefty net loss of $350 million. So, yeah, it's a massive turnaround.
Wow. Okay.
It kind of proves the model can generate returns,
And the revenue engine seems to be revving up, too.
Absolutely. Total net revenues hit $2.4 billion in 2024. That's roughly 26% year-on-year growth. Pretty robust.
What's driving that?
It's a mix. Increased user activity, so more people trading more often, and also higher net interest income. And what's really interesting here is their growth margin. It's high, around 75%.
75%, that's quite high.
It is, and it reflects the nature of their trading revenue. Once the app infrastructure is built, generating payment for order flow, or PFOF, costs very little extra.
Yeah.
So it's an incredibly high margin model if the trading volumes stay strong. That's the caveat.
Okay, speaking of structure, let's talk balance sheet. It looks incredibly solid from the sources. This isn't some growth company drowning in debt.
Not at all. As of year-end 2023, they reported, get this, $6.3 billion in cash and cash equivalents.
$6.3 billion. That's a huge cushion, especially given the regulatory stuff they deal with.
It is. And their debt, almost negligible. Total debt is only about $250 million.
So the leverage metrics must look great.
Yeah, if you look at the debt-to-equity ratio, it's comfortably under 0.1x. Basically, they're self-funding.
Which gives them a lot of flexibility.
Exactly. Tons of operational flexibility, minimal liquidity risk.
Yeah.
Plus, they reported $700 million in positive operating cash flow for fiscal 24. So financially, they're on a very conservative, very resilient foundation.
Okay, solid foundation. But it's a tough neighborhood they operate in. Who are the main competitors they're duking it out with? And where's their Achilles heel, maybe?
Well, it's definitely cutthroat. On the traditional side, you've got the behemoths like Charles Schwab, E-Trade, which is now Morgan Stanley, remember?
Right.
And then in crypto, Coinbase is the big rival. Robinhood's advantages. Still the brand, that low-cost structure, and, the user experience is famously clean.
But that monetization, it all hinges on PFOF and net interest margin, right?
Yeah.
Could you maybe just quickly unpack PFOF for listeners who aren't, deep in the broker weeds?
Sure. PFOF, payment for order flow. Basically, instead of sending your trade order straight to an exchange, the broker routes it to a market maker. That market maker pays the broker, like Robinhood, a small fee for the chance to execute your trade. That's the mechanism that lets them offer commission-free trading.
Got it. So what's the downside?
Well, it's sort of twofold. First, customer loyalty or stickiness. It tends to be lower than with traditional brokers who offer, full wealth management services.
Right.
And second, that revenue stream, PFOF, it's under a regulatory microscope, and it's super dependent on retail trading staying hot.
Okay, that sets us up perfectly for the market side. They've got the cash, the foundation seems solid, but are investors buying into it?
Yeah.
What are the charts saying right now, say late September 2025?
Well, looking at recent price action, the stock's been consolidating a bit, trading mostly between $11.50 and $13.75.
Right, after that strong run earlier in the year.
Exactly. Came up from the mid-$8 range, so some digestion makes sense.
What are the key technical levels we should be watching?
Okay, two crucial levels here. Support seems pretty firm, down between $11 and $11.50. If that level breaks, the trend might be reversing.
And on the upside?
Resistance looks strong between $14 and $15. And that $15 level isn't just random. Sources suggest it's near the volume-weighted average price, the VWAP, for some big institutional buyers who got in post-IPO.
Ah, so breaking above $15 could be significant. Means those big players are finally in the green.
Exactly. It could signal more conviction for the price to run higher.
And the technical indicators, do they back up this sort of medium-term bullishness?
Yeah, they generally do. Prices above both the 50-day and the 200-day simple moving averages. That's usually a good sign.
Yeah.
And the MACD indicator is positive, suggesting momentum is still, intact for now.
You mentioned volatility earlier.
Right. I got to throw in a word of caution there. Robinhood stock is inherently more volatile than its more traditional peers.
Why is that?
Because its business is so tied to retail sentiment, event-driven news, crypto swings. You should expect sharp moves. It's not just driven by macro stuff.
Okay, good point. Now, moving beyond the charts, the recent news flow has actually been pretty encouraging, right?
It has, yeah. They announced Q2 2025 results that beat the top-line estimates.
What drove the beat?
Again, it was strength in crypto trading volumes, and importantly, that higher net interest income from cash balances. They're making good money on idle cash.
And analysts are taking notice.
They are. Morgan Stanley just upgraded the stock to equal weight, put a $13 target on it, and the overall consensus seems cautiously optimistic. Targets are clustering, maybe $13 to $16.
Okay, but here's where it gets interesting, maybe contradictory. Retail sentiment, if you look at Reddit stock twits, it seems pretty positive, right? People are bullish.
Mm-hmm.
But what are the insiders doing? The people who know the company best.
Yeah, that's the slightly uncomfortable counterpoint you have to consider. We've seen a pretty steady stream of Form 4 filings all through Q2 and Q3 of 2025. And they show ongoing programmatic selling by top executives. We're talking key founders like Baiju Bhatt, the CFO, Jason Warnick.
Programmatic or not, if the fundamentals are solid, profits are up, outlook is bullish, why are the key people consistently trimming their stakes?
That's the million-dollar question, isn't it?
It doesn't exactly project long-term confidence.
It definitely raises a valid question about their conviction at these price levels. The company narrative is all about growth and stability, but these consistent sales, they introduce a bit of skepticism, especially given the stock's already, fairly high valuation.
Okay, that leads us right into the future outlook. Healthy balance sheet, decent momentum. But what are the catalysts? What specific things should we be watching that could move the needle?
All right, short-term catalysts. 3 dates to circle on your calendar. First, Q3 2025 earnings, expected around October 24th. Volatility almost always ramps up into earnings.
Okay, earnings. What else?
Second, October 3rd. That's when index inclusion announcements for ETF rebalancing often happen. If Robinhood gets added to some key mid-cap ETFs because its public float has increased.
That could create forced buying from index funds, a technical tailwind.
Exactly. Could provide a nice little boost. And third, November 20th. That's when the institutional 13F filings come out.
Ah, showing who owned what at the end of Q3.
Precisely. We'll get to see if the big money managers were buying, selling, or holding during the third quarter. Crucial insight into institutional sentiment.
Okay, those are the short-term triggers. What about the longer-term picture? Their strategy seems to be shifting, right? Trying to move beyond just relying on that volatile PFOF stuff.
Yes, exactly. That strategic shift is absolutely vital. The sources point to a few key things. There was that partnership announced in August to enhance wealth management offerings. That's a direct shot at the legacy brokers.
Trying to compete on more than just price?
Right. And then there's the planned rollout of their premium accounts, set for December 19th. This isn't just about adding features, it's about making customers stickier and boosting revenue per user.
So the idea is these premium services, the wealth tools, they're meant to offset the PFOF risk, provide more stable, maybe subscription or asset-based fees.
That's the plan. They're betting on the fact they have, 20+ million accounts. The core thesis for that higher valuation, that 25 times PE we'll touch on, isn't just about today's PFOF profits.
It's about the potential.
It's about the optionality, yeah. Successfully cross-selling those millions of accounts into higher margin wealth products. Plus, they're still pushing on international expansion, EU, UK, expanding their addressable market.
Any other potential growth areas mentioned?
Well, there are rumors, market chatter, about a more aggressive crypto platform push, maybe into new EU markets, and talk of an imminent beta rollout for some advanced AI-driven portfolio tools.
Okay, lots of potential growth drivers. But we have to talk risks. What are the main things that could derail this whole story?
Number one risk still is revenue concentration. Their results are just highly sensitive to two big variables: overall retail trading activity,
Which can be fickle.
very fickle, and consumer interest rates. If either of those drops significantly, it hits their PFOF and net interest income hard.
And then there's the big one, the regulatory cloud.
Oh, absolutely. That's probably the largest sort of unpriced risk hanging over the stock. The regulatory overhang is critical. There's ongoing scrutiny generally, but the main event right now is that Wells notice they got from the SEC back in August, specifically about their crypto business.
Can you just clarify, what exactly does a Wells notice mean for people who haven't heard that term?
Sure. It's basically the SEC formally telling the company, our staff plans to recommend enforcement action against you.
So it's a formal warning shot.
Pretty much. It means the company knows the regulator intends to bring charges. It basically says, we think you did something wrong and we're likely coming after you.
Which creates huge uncertainty.
Massive legal uncertainty, yeah.
Yeah.
Potential fines, changes to their business model, plus the ongoing high cost of just fighting it legally. That uncertainty alone keeps some institutional money on the sidelines.
Okay. And any other major risks?
Just the general market risk, really. The whole brokerage sector is facing pressure on pricing. Commission-free is the norm now, so Robinhood's original edge there is gone.
Right.
And like we said, retail trading is cyclical. The whole business is sensitive to broader economic downturns.
Okay, so let's try to synthesize all this. We've got improving financials, solid balance sheet, bullish technical momentum for now, but also this strategic pivot, the reliance on volatile factors, and this big regulatory question mark. What's the overall takeaway from the sources, the investment thesis summary?
Based on everything in the source material, the overall rating given for Robinhood is kind of right down the middle, a 6 out of 10.
A 610.
Yeah.
Okay, why just moderate? Why not higher, given the profit turnaround and growth?
Well, the rationale is a bit nuanced. The fundamentals are improving, no doubt. Profitability is there, the balance sheet is strong, lots of cash. But the market seems to have already priced a lot of that in. The stock's trading around 25 times earnings. That's a pretty significant premium compared to the older legacy brokers.
So that premium is basically a bet on future success.
It's a bet on them successfully executing that shift into wealth management, capturing that optionality. And until that success is actually proven, that high valuation, combined with the very real regulatory risk, well, it makes it more of a cautious hold than an aggressive buy, according to these sources.
So who is this stock potentially for then?
The conclusion seems to be that long-term investment is probably only suitable for investors with a high tolerance for risk, people comfortable riding out the inevitable volatility from regulatory news in those trading cycles.
And for shorter-term traders.
Actually, the sources suggest it might be better suited for volatility-driven, event-focused, short-term trading. Playing those specific catalyst dates we talked about, earnings in October, potential index inclusion, the 13F filings in November.
Okay, that really crystallizes the tension here. Profitability is growing, momentum looks good right now. But the whole thing is fundamentally tied to two really unpredictable things: how much retail investors feel like trading, and how regulators feel about PFOF and crypto.
That sums it up pretty well.
All right, here's a final provocative thought for you, the listener, to mull over. Given how serious that Wells notice is, and the company keeps saying they want to resolve these regulatory issues, what do you think the market reaction would be if that speculative rumor, the one about a potential SEC settlement agreement, actually came true before year-end?
Ooh, yeah.
It wasn't explicitly in our sources, but it's definitely out there in the market chatter. If they could resolve that major uncertainty, potentially in one go.
That could be a game changer.
It really could fundamentally shift the risk-reward calculation almost overnight. Something to think about. Well, thank you for joining us for this analysis of Robinhood markets. We hope this breakdown gives you the concise, useful insights you need to make your own informed decision. We'll be back soon with another Investing Talk podcast.